Hello friends. So today I'm going to be talking to you about synthetic call option. That is my topic for the video today. This comes under the overall ambit of risk management in derivatives. The intended audience for this topic is the CFA final students as a part of the subject strategic financial management. The CFA students, very relevant for the undergrad and postgrad programs in the MBA colleges also when they are studying risk management in derivatives. So now the intended coverage of this particular video is I'm going to explain to you what is put call parity, the importance of put call parity, and how that put call parity can be leveraged and utilized to create synthetic options. Within synthetic options, I am going to be explaining to you the synthetic call option, how does it work, and the interpretation and inferences that you can draw from that particular strategy. So let me quickly take you to my writing board where I am going to illustrate to you how the put call parity works. Now, to be able to understand the put call parity, you must first understand what is a call option and what is a put option. Just a brief background. A call option is an option to buy a particular security or an asset at a predetermined specified period of time and at a predetermined price, which is called the exercise price or the strike price. Put option, on the other hand, is an option to sell a security or an asset at a predetermined specified period of time and at a predetermined specified price, which is called the strike price or the exercise price. I know most of you would already be aware of the call options and the put options, but now I also would like to take the opportunity for you to introduce a new portfolio to you, and this portfolio is called the Fiduciary Call Portfolio. So let me quickly write this down. This portfolio is called the Fiduciary Call Portfolio. Fiduciary Call Portfolio. Now, what is a fiduciary call portfolio? A fiduciary call portfolio will allow any particular investor or trader to go long on a European call option. That means you will basically go long or buy a European call option, and you will also go long on a bond, a risk-free bond. Okay. Now, the price of the call option I am going to denote as C0. That is my price today. And the price of the bond I am going to denote as X divided by 1 plus RF raised to the power of T. Now let us understand the meaning of each of these. When I buy a call option, it gives me a power of choice. Because it gives me a power of choice, I have the right but not the obligation to exercise my option. Therefore, this power of choice comes with a particular premium or a charge. That is the price of the call option. So if you are going long on a call option, a European call option to be specific in this case, you are actually paying the price to exercise the option at a later date, and that price I am denoting as C0. Along with that, we are also investing in the bond. Mind you, the price X that you see here, that is what you're going to receive on the expiry of the bond X, and that coincides with the exercise price or the strike price, which means when the European call option on its maturity, you will be able to buy the underlying stock at a price X upon the expiry of its period, which is T, right? And the bond currently trades at a discounted value, so that at the maturity T, it is going to give you that proceeds X, which you can possibly use to buy the underlying stock by exercising the call option. Hence, The present value of the bond is nothing but x by 1 plus rf to the power of t. I hope this is absolutely clear to you, very critical. So now let us quickly also try to understand the payoffs that you can generate from this particular option. I give you maybe 10 seconds to quickly note this down, because this is going to be relevant in the future analysis that I'm going to show to you. And for the moment, I'm going to rub this and move forward. So now let us quickly draw a payoff table for this fiduciary call option. When you are drawing the payoff table, remember there are two options or two scenarios rather, that we are going to be talking about. The first scenario is the spot price in the market at the time period T is either less than or equal to the exercise price or the strike price. Now, what will be the payoff on the call option? If the spot price at maturity for the stock is less than or equal to the exercise price, would you exercise the call option? My answer will be no, and therefore the payoff from this call option is zero. Why would you not exercise this call option? Because if you exercise this call option, you will have to buy the underlying stock at a price X, whereas in the market it is available at a lower price ST at the maturity, which is time period T. Therefore, you will not exercise the call option and pay a higher price for the stock when it is actually available at a lower price in the market. What about the bond? You remember in a fiduciary call, you have gone long on the European call option as well as the bond. Now, this bond is obviously going to give you a price of X at maturity. Remember, when you had invested in the bond, you had actually the present value of the bond was X by 1 plus RF to the power of T, and that will grow to a price of X upon the expiry of or the maturity period T using a discount rate of RF or the risk-free rate. What happens if the spot price at the time period T or maturity T is more than the exercise price? If the spot price or the price in the market at a time period T is more than the exercise price or the strike price, will you exercise the call option? You will obviously exercise the call option, because now you can buy the underlying at a smaller price or a cheaper price X, whereas it is available in the market at a spot price of ST at time period T. Because you can exercise this option, you can buy the underlying stock at X and sell it in the market at ST, and therefore the gain that you make by exercising the call option is ST minus X. So I'm going to put this down here. The payoff on the call option exercise is ST minus X. Now the bond in either scenario will yield a price or the value of X. Now if you look at the total payoffs, you will have a payoff of X in case of the first scenario, and a payoff of ST in case of the second scenario. That means if the spot price is lower than or equal to the exercise price, the total payoff from the fiduciary call option is X, whereas if the spot price in the market is more than the exercise price or the stock price, the payoff at maturity is ST, right? So this is the total payoff matrix in the two scenarios for the fiduciary call option. I hope you would have noted it down, and now let us move forward and determine what is the second one, the second portfolio that I'm going to be talking about. Now I am going to be talking about a new portfolio, and this portfolio I am going to nomenclate as the protective put portfolio. Protective put. Now, what does a protective put entail? As per a protective put, you go long on the put option, on a European put option, and you also go long on the underlying stock. So now, therefore, you are going long on two things. One, the European put option, and you are also going long on the underlying stock. These are the two things you are going long into. So I hope you would have copied this. So to understand a protective put option, you're going long, you're buying a European put, which will allow you to sell the underlying stock at a predetermined specified price X upon the expiry of the period T. And you're also buying the underlying stock. Now I hope you would have noted this down, and let's move forward and determine what is the payoff of this particular portfolio, which is protective put. So I'm again going to draw two scenarios. The first scenario is when the spot price in the market is less than or equal to X, and when the spot price in the market is more than more than, not equal to, rather just more than X. So we'll ignore this equal to, that's not required. It is just more than X. Now, when what is the payoff of the two instruments in this particular portfolio, which is called a protective put? Now, if you are, just to make it clear for you, yeah, this is much better. The second scenario is when the stock price is more than the exercise price of X. Now, if you are exercising a put option or a protective put, if you have invested in a protective put, there are two scenarios. One, spot price at the time period T is either less than or equal to the exercise price. If the spot price is less than or equal to the exercise price, you are actually, will you exercise the put option? My answer is yes. Why? Because you are able to sell the underlying stock at a price X, which is higher than the price you would fetch had you sold the stock in the stock market, or the open market rather. So therefore you will exercise the put option. So you will buy the stock, you can buy the stock, you can buy the stock actually in the market. Theoretically you can buy it at a spot price ST and sell it in the market at X, and therefore the gain that you will get on this particular scenario is X minus ST, because the exercise price that you're getting is now higher than the spot price in the market. Now, remember, you can sell the initial stock which you had purchased at S0 at this price ST in the market. Remember, right? So, now let's move forward to the next scenario. If the spot price is more than the exercise price, what happens in this case? In this case, will you exercise the put option? My answer is no, and hence the payoff in this case will be zero. Why? Why would you sell a stock at a lower price when it can be sold in the open market at a higher price? Okay, and the initial stock which you had purchased at a price of S0 at inception, that you can sell in the market at the current market price of ST. So now what is the total payoff? The total payoff here is X, and in this case the total payoff is ST. Now my dear friends, if you would have taken notes, you would have understood that whether you take the fiduciary call option or the protective put option, the total payoff from the portfolio remains X if the spot prices are lower than the exercise price at maturity, and remain ST as long as the spot prices are more than the exercise price on maturity. Therefore, in an ideal situation, whether you take a fiduciary call option or a protective put option, you are going to get the similar return X in the first scenario and a similar return ST in the second scenario. Therefore, my dear friends, now we come to the conclusion of this particular equation, which is called the put-call parity. It's only obvious that I denote this by put-call parity. Why? You would have understood now. Whether you invest in the fiduciary call portfolio or the protective put portfolio, your payoffs are going to remain same in either of the scenarios. Now, let's quickly also let me kind of draw this in the form of an equation. My total investment in the fiduciary call option, I will demarcate as C0 plus X divided by 1 plus RF to the power of T. I'm sure all of you would agree to this. Remember, in a fiduciary call option, we went long on a in case of a fiduciary call portfolio, we went long on a European call option and we went long on the underlying bond. My total investment or the total cash outlay at the beginning was the price of the call option C0 and the price of the underlying bond, which is X by 1 plus RF to the power of T. And my total outlay in case of the protective put option will be the protective put portfolio will be the price of the put option P0 and the price of the underlying stock, which is S0. This, my dear friends, is what is called as the put call parity equation. What is interesting, I hope you would have noted this equation as of now, and what is interesting is you can create certain combinations out of by utilizing this put call parity option. We now move to a second topic for this particular video, which is synthetic options. Now, why synthetics? When you use the term synthetic, what is a synthetic material? It's maybe a mixture of cotton and polyester yarn. So whenever you use the term synthetic, we are referring to a mixture. Same way, a synthetic option would be probably a combination of two options or a combination of the option and the underlying stock. So let's try and understand what a synthetic call option is. If I were to create a synthetic call option out of this particular equation, can I rewrite the equation as C0, which is the price of the synthetic call option, should be the price of the put option plus the price of the underlying stock minus the discounted price of the bond, or which is the exercise price that prevails today. If you rearrange the equation that I just mentioned to you solving for C0, you should get this particular equation. This, my dear friends, is how a synthetic call option is created. And you would have understood, in case of a synthetic call option, you are going long on a put option, you are buying an underlying stock, and you are also discounting you're shorting the bond at the current date, which is basically your exercise price borrowing, you might say. Now, how do you align this or maybe objectify this in case of a live scenario? Let me show this to you on Excel, right? Now, if you look here, let's take the hypothetical example of a trader. Let's say a trader has just invested in a Reliance, in any stock, maybe a stock of Reliance, and the stock of the Reliance maybe today, I'm just taking a hypothetical figure. Today, S0 is the spot price of the stock that you're buying today. Let's say the stock is trading at 720 and he has bought this stock. Now, he has bought this stock because he's hopeful, he's pretty bullish about the market conditions. So he is hopeful that the prices of this stock is going to rise in future. So he has invested in the stock or he has gone long on this underlying stock, right? However, he wants also to hedge his possible risk because he doesn't know. Maybe there is volatility in the market, or maybe because of unprecedented conditions, the market declines. He wants to put hedge against the possible decline in the value of the stock. So what he will do is, along with the stock that he has purchased, he will also purchase a put option which allows him to sell the stock at a predetermined specified exercise or a strike price of 700 rupees. So remember the definition of a synthetic call. He has gone long on an underlying stock and he has gone long on a put option. So these are the two investments he has made. Now let us also examine, let's take various scenarios. What I have drawn for you. What if on the maturity or the expiry of the option or on the date when the option can be exercised, these are the possible market prices which can prevail. 650, 660, 670, right up to 800. What I have tried to tell you is, will he exercise the option? Yes or no? Very simply put, as long as the price in the market is less than the exercise price, he is going to exercise the option. Very clear, because he is going to get a higher price of 700. Why would he sell the stock in the open market at 650? He will exercise the option. So if you see here, up to 700, he is exercising the option. After that, he stops exercising the option. Why? Why would he sell a stock by exercising the put option at 700 when it can be sold in the open market at 720? So he does not exercise the option there. What I have tried to also emulate or simulate is the possible option gain. Now, what is the gain? So, if you were to take the gain, let's talk of the first scenario. If the market price on the option settlement date or the option exercise date is 650, we are assuming that obviously he will exercise the option and he will sell the stock at 700 rupees. Mind you, dear friends, he had bought this stock for 720, right? And he is sold it for 700. So there is a loss of 20 he has incurred. Over and above that, there will be the option price. Let's say this is 10 rupees. So his total loss is 30. But what if his thinking was right and the stock price actually becomes 750 on the option exercise date? If the price is 750, will he exercise the option? No. He has the power of choice. He does not exercise the option. Rather, he sells the stock in the open market at this price of 750. So what's his gain now? He bought the stock at 720 and he's selling this stock at 750. Thereby, he is making a gain of 30, right? If you reduce from this the option price, maybe which is 10, he is actually making a gain of 20 rupees net on his position. What if it is 760? Then he again does not exercise the put option. He sells it in the open market at 760. The stock which he had bought at 720 gets a profit of 40. If it is 770, even higher. If it is 780, even higher. If it is 800, even higher. What does this scenario tell you? If you look at this scenario carefully, 720 is obviously his break-even price because that's the price which he has bought the stock. Rather, I would say 730 is the break-even price because at 730 he makes a profit of 10, but 10 is the option price. So net he doesn't make any profit. But beyond 730, if you see, he is making unlimited profits. So that means if the market prices are above the exercise price of the stock price, the probability of him getting a gain is unlimited. There is no cap there. Sky is the limit for such kind of a price rise. But what if the price falls below? If the price falls below, you will see he has actually capped his loss at a fixed amount, right? Because he has taken a put option. That put option protects him from unlimited losses and he is able to fix his loss or cap his loss at a particular figure. This, my dear friends, is how a synthetic call option works. Just to summarize, this trader was bullish about the market. So he invested in the stock, hoping that the stock prices will rise, but also hedged his position by buying a put option to protect himself from any unanticipated decline in the market, right? So therefore, his profits are unlimited, whereas his losses are limited. That's how a synthetic call option works, and I have also illustrated this to you in terms of a graph. Now, if you look at his graph here, if you look at this portion, his profits are limited, right? Whereas his loss gets capped. You see the straight line here? The loss gets capped if the market prices are below the strike price or the exercise price. Right? So with this, my dear friends, let me go back to the intended coverage, and we have covered the put call parity. I have explained to you what are synthetic options, and I have also explained to you how does a synthetic call option work. I hope you enjoyed this video. Keep subscribing to my channel on YouTube called Concept Canvas, and keep watching videos and stay tuned. Thank you very much.